Thank you, Mr. Chairman. I can see how once this crisis is over, we can divide up on philosophical lines. I've read the complete works of Ayn Rand, or at least I'll claim I have, because I can state with confidence that Ayn Rand says nothing positive about either Fannie Mae or Freddie Mac. And if we were not in a crisis, we could divide up on the role of government and overall philosophy. But we are in a crisis. The economy's fragile, and we need to be practical. A double-dip recession is a very real possibility, and the most likely way that that will occur is another precipitous drop or long slide in home prices. And loose talk here in Washington can add to that crisis. There are those on another committee talking about ending the home mortgage deduction. Great philosophical debate for good times. But right now what it means is, why should anybody in my district buy a home if a couple of years from now they're going to lose their home mortgage deduction, and 5 or 10 years after that, when they go to sell their home, it's going to sell 10, 20, 30% less than what it would otherwise. Some would say an even greater drop. If we were to end the system whereby a federal agency guarantees qualifying, conforming mortgage loans, we would see a dramatic increase in home mortgage costs, a dramatic decline in values. The dramatic decline in values would then lead to a dramatic increase in defaults, and we would have a double-dip recession. That's why I'm a little concerned about the title of these hearings, which talk about protecting taxpayers from the ongoing bailout of Fannie Mae and Freddie Mac. That may be a noble goal, but we also have to protect taxpayers from the precipitous removal of Fannie Mae and Freddie Mac from the housing system in this country, and we have to protect taxpayers from a double-dip recession. A second dip could mean double-digit unemployment and could make our situation even worse than that which we've recently experienced. Now, Mr. DeMarco, one issue is the size of the portfolio held in the safes of Fannie Mae and Freddie Mac. How large is that portfolio, adding the two agencies together?
Six out there, about 1.3 to 1.4 billion.
Now, if all of that was dumped on the market,
trillion. Sorry about that.
What?
Trillion. Billion.
Yes, I knew you said trillion even without the correction. If that was precipitously dropped on the market, would Fannie Mae and Freddie Mac secure full value for the assets they were selling?
No, sir. If you're talking about selling 1.3 trillion all at once, no.
In fact, if there was even a precipitous decline in the size of that portfolio within any particular month, wouldn't that affect the market price of the assets being sold and cause Fannie and Freddie to not be able to secure full value?
It could.
I yield back.
But to the gentleman from California, 5 minutes.
I wish the gentleman from New Jersey was right, and Dodd-Frank completely eliminated the too big to fail. As you know, we had a number of amendments to Dodd-Frank that might have allowed it to achieve that objective.
Yeah.
I think Mr. Dalton is to be commended on his most recent answer and the wisdom that lies behind it. Professor Wachter, I think, is right in that the worst thing we could do to our economy is to see a slide or precipitous drop in home prices. And the biggest thing we can do to protect Fannie Mae and Freddie Mac is to make sure that they're not buying subprime loans and alt-day loans and liar's loans, and that we've already done. The barn is much better now that we've closed the door. I don't know what changes we would have to make short term that exceed the importance of that. Mr. Phillips, I just want to reemphasize what you just said. The average non-homeowning family in this country has an average net worth value of everything they own in the world of under $5,000.
Correct.
That's a strong argument for promoting home ownership. I can commend the gentleman from Staten Island on the importance, on his statement that we should keep the home mortgage deduction. Now, what's most likely to happen in Congress is we'll have a lot of talk about eliminating the home mortgage deduction, and then we won't actually do anything. So whatever federal revenues are available from not doing anything will be available, that is to say zero. But what effect does it have on today's home prices that people are reading that Congress might eliminate the home mortgage deduction, which means when you live in the home, you don't get the home mortgage deduction, and when you sell the home, you sell it for an awful lot less. I would think from your position as president of the National Association of Realtors, you could give me some insight into what this talk is doing to home prices.
What all the conversations, and particularly the conversations on mortgage interest deduction and its elimination do, is cause people to pause. So when we have an overhang and an oversupply of the market, to discourage qualified, ready, willing, and able buyers from stepping into the market means that you have a further eroding of average price. It's particularly challenging, and the conversation I personally find frustrating because it's something that my grandparents, my parents, and I benefited from to pay down and pay off the 30-year mortgages. It feels like generation theft that my kids and grandkids cannot enjoy the benefit that we've had in place since 1913.
Now, if Fannie and Freddie hold portfolios of well over $1 trillion collectively, if their plan is to sell those off or reduce that holding of mortgages by about 10%, is that too precipitous, too fast, both to keep the housing market in good shape and keep the funds flowing to the housing market, and to make sure that Fannie and Freddie get full value for the assets that they're selling? Is 10% a year faster than it ought to be? Or should I prefer to...
Actually, I would prefer you ask. I think the
let me
frankly,
ask the
is
professor.
the successor.
I think that Director Ed Marco did actually respond to that in a way. He was asked whether 5 years is too precipitous, and he said there is no way that I can answer that question. In the same way, 10%
But you're
at this
smarter.
moment in time, no, by no means, 10% at this moment in time does not appear to be threatening the recovery. But that's not to say that next year, because we are very much on the margin. So presumably,
So
if things
we should
become more
encourage
risky,
the 10%, but maybe not mandate it in a way
mandatory
that would
is
lock
exactly
it in.
where you do not want to be on this.
Mr. Phillips, I come from a high-cost area, Los Angeles. If the conforming loan limit drops, what does that do to home prices in the 10 largest cities? And then I'll ask the professor whether that likely drop in home prices would adversely affect the economy. But
The
first,
answer is that it will actually force down prices. What's really interesting is it's portrayed as a coastal issue when in fact we're looking at 29 states having high-cost areas, 206 counties, and it impacts 51 million Americans. So it is a significant portion of this country that has broad demographics.
and if all of a sudden every home that used to be worth $800,000 in the LA area dropped to a value of $500,000, Professor, what would that mean for the national economy?
This will certainly create regional recessions, and beyond that, of course, if we have a price
But only in our 10 biggest metropolitan markets.
if we have a price climb of that magnitude.
I yield back.
Great, thank you. Gentleman from Texas.
The record should show that when I say only the 10 largest markets, that was facetious.